We are breaking down the tax treatment of long-term care insurance and health savings account distributions for your health insurance exam. These are two areas where the test loves to use specific numbers and age triggers to try and trip you up. Let's start with tax-qualified long-term care insurance. The exam expects you to know that for a policy to be tax-qualified, it must meet certain standards set by HIPAA. The benefit of having a tax-qualified plan is the favorable tax treatment. First, the premiums. The portion of premiums paid for a tax-qualified LTC policy can be considered a medical expense, which may be tax-deductible. However, the key exam point is that this deductibility is subject to age-based limits. You won't need to memorize the exact dollar amounts for each age bracket, but you must know that a 70-year-old can deduct a higher amount of their premium than a 45-year-old. Now for the benefits. When a policyholder receives benefits from a tax-qualified LTC plan, those benefits are generally received income tax-free. The exam trap here is the existence of a limit. This tax-free treatment only applies up to a certain per diem or per day amount, which is indexed for inflation. So, if the daily limit is, for example, $400 and the policy pays out $450, that excess $50 could be subject to income tax. Now let's pivot to health savings accounts, or HSAs. The exam is less concerned with contributions and more focused on distributions. It's simple when the money is used correctly. If an HSA distribution is taken to pay for a qualified medical expense, such as a doctor's visit, a prescription, or dental work, the distribution is always tax-free and penalty-free, regardless of your age. The complexity and where test questions are born comes from non-qualified distributions. Imagine a 50-year-old takes money from their HSA to pay for a vacation. Because this is not a qualified medical expense and they are under age 65, they will face a double consequence. The distribution amount is added to their gross income for the year and taxed. Plus, they will be hit with a 20% penalty on the amount withdrawn. This 20% figure is a critical number to remember. But the rule changes at age 65. This is a common point of confusion on the exam. If an individual who is age 65 or older takes a non-qualified distribution from their HSA, the 20% penalty is waived. They still have to pay ordinary income tax on the distribution amount, but the penalty disappears. Essentially, after age 65, an HSA can be treated like a traditional IRA for non-medical withdrawals. Here's a simple way to keep it straight. Think 20 before 65. This phrase connects the 20% penalty to non-qualified withdrawals for those under the age of 65. Once you hit that milestone, the penalty is gone, but the tax man still gets his share. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.